All right, welcome to today's Lunch and Learn webinar, Succession Planning, your guide to choosing the best exit strategy, brought to you by ArcherPoint and Redpath and Company. Many business owners are concerned about the notion of transferring the equity interests in their business. There are numerous succession planning strategies available, and understanding all your options can be challenging, but is essential in choosing a path that's right for you. This webinar will help business owners evaluate their options in order to identify the exit strategy that best aligns with their business and personal goals. We'll evaluate the pros and cons and help you understand the planning and execution process behind each strategy. Our presenters today are Brian Sweeney and Emmett Mulcahy from Redpath and Company, a 100% ESOP-owned CPA firm. Brian Sweeney, CPA audit partner and ESOP practice team leader, works with privately held and employee-owned companies focusing on client services, financial health, and cultural consulting. Emmett Mulcahy, CPA, CVA, and valuation service area leader at Redpath, assists clients with business valuations, mergers and acquisitions due diligence, strategic planning and forecasting, and financial modeling. Emmett and Brian will walk through each strategy to help business owners weigh their pros and cons, providing insights built upon years of experience assisting clients with their own exit strategies. We will have a Q&A at the end of the presentation. Please either type your questions in the questions pane of your GoToWebinar console as we go along, or use the raise your hand option to ask your question verbally during the Q&A. I'll announce the person asking the question and unmute your line at that time. So without any further delay, let's get started. Emmett, over to you.
All right, thank you, Suzanne, and good afternoon, everyone out there. I'm Emmett Mulcahy, and as Suzanne stated, Brian and I will be taking you through your various succession planning options once you decided you're ready to hang it up, and I'll also touch on a couple other items you should be thinking about in the meantime to consider during the succession planning. Before we get started, though, I think I need to make our marketing department happy and tell you a little bit more about Redpath and Company. We're a 100% employee-owned public accounting firm and provide CPA services for closely held businesses and their owners, government entities, and not-for-profit organizations. These services include standard audit and taxes practices, as well as benefits compensation administration, international consulting, mergers and acquisitions, succession and estate planning, and valuation services. And then finally, we're based here in St. Paul, Minnesota. So now that we have that covered, we can dive into some succession planning. We've got a lot to cover and also want to leave time at the end for questions. Again, thanks all for attending, and let's move into some things you should be thinking about before you transfer your business. So transferring your company isn't something that's going to happen overnight, and there's a lot you should be thinking of before you even get to that phase. The first step, which I assume you've all have taken since you're attending this webinar, is to realize that you need to have a plan in place. Many business owners I see just bury their heads in running the company and are focusing on growth and either don't take the time or don't want to look up and think about what's next. And one reason for this is that running a business is really all they know, and they haven't figured out what they really want to do yet in retirement. So my first piece of advice is to really sit back and figure out if there's something else you want to be doing other than working. Here at Redpath, we work with owners whose plans range anywhere from just stepping away from the business to spend time with family, to traveling the world. And here in Minnesota, we have people who just want to spend their time fishing. And we also see people that want to continue to work, but maybe in a different capacity. Some go into teaching part-time or starting consulting practices where they're just able to kind of pick and choose when they want to work. And others will move away from the day-to-day operations with their company, but will continue in some fashion, maybe as a member of the board of directors. And as you sit back and start to think about what's next, I'd also encourage you to talk to your family members. I think it's pretty common. You talk to business owners and they say they want to work forever, and then you talk to your spouse and they may have different ideas. So it's, not uncommon to have conversations and the owners say, I think I want to work an additional 10 years. And then they talk with their spouse and all of a sudden they come back and that time frame is all of a sudden 5. And then finally, having a retirement plan in place is really going to make you think about what kind of lifestyle you're going to live and how much money that's actually going to cost. If you think about it, the amount of money you spend just sitting back and spending time with family is going to be drastically different than the money you spend jet setting around the globe in your later years. So it's really important to talk and work with your advisors to put a plan in place so you can kind of figure out what kind of cash it's going to take to live the lifestyle you want. And these are the conversations that are really going to play an important role in determining what succession planning route is right for you. And then I'd say, typically funding your lifestyle is one of the main goals for retirement planning. But, once you have your lifestyle plan figured out, it's also important to think about what other goals you'd like to accomplish during succession planning. So I'd encourage you to think about things like, do you want to set up your children or grandchildren? Do you want to give back to your employees? Do you want your company legacy to continue after you're gone? Knowing the answers to these questions are also going to help you kind of frame what path you should be taking. And then I'd say another item to consider is maybe you're not fully ready to retire anytime soon, but you're getting older, and maybe you're just thinking about diversifying your assets. It's, I'd say, fairly common from what I see is that many business owners, their company easily accounts for almost all of their net worth, and perhaps selling a small minority piece or maybe even a controlling interest in the company is going to be a good way for you to take some money off the table and diversify your assets later on in life while you're still working. And if that's the case, there are certain options you're going to want to look at and consider. And then lastly, before we move into the various options here, even if you're dead set on working until you die, having a plan in place is a smart idea just as a contingency, just in case something happens to you. This way the business isn't going to be completely disrupted as other people try and figure out what happened next. All right, so with that, I'd say let's get into some of the succession planning options. And the first one I'd like to talk about is a management buyout. So a management buyout is a popular strategy where either an individual or a small group of employees is going to purchase the company from you. And this is really a great option if you want to preserve your company culture, and can also be a pretty seamless transaction that doesn't need to be made public if that's something that concerns you. Additionally, this is a pretty friendly transaction as you, the business owner, can pick who you'd like to sell to, help groom them, and really make sure you leave the company in the best hands once you're gone. And then also, really from a transaction point of view, this is a pretty easy deal to get done since the buyer, they're already working in the company and should know the business almost as well as you do. With these transactions though, from my experience, the sellers who sell to management aren't ever really looking for the highest dollar amount and tend to be very willing to work with buyers and sellers for a fair price. And I would say this is a pretty important aspect in a management buyout because in these scenarios, the buyer likely doesn't have the amount of cash necessary to fully pay you off all at once, so you can just pick up and walk away from the business. So typically, kind of how we structure them and what we see happen is there may be a small down payment, but then the seller is going to allow the buyer to then finance the remaining of the purchase price through the cash flows of the company over a certain amount of time. And what this really means is that you, the seller, and the buyer are really going to have to work together to determine a fair price, both for you and then also for the buyer, so you're not restricting future cash flows of the business so much that they can't continue to operate as they normally would and pay you off. And this kind of leads into one of the biggest risks of this type of transaction is that all of a sudden the new buyer can't continue to operate the business as needed to fund all your payments. And really this means you can't completely step away from the operations, and you're going to have a stake in it, so you're going to want to continue to make sure things are running smoothly and that you really left it with the right people in the right places. Because you really want to avoid the worst case scenario where you have to step back out of retirement and into the business to get things back on track. But luckily though, if you have some good advisors with some good planning, you can really help mitigate these risks as much as possible. And as I said before, the management buyout is a very friendly, seamless process. And you really only have to involve attorneys, CPA, and then a valuation professional to agree on a price and structure a deal in the best way possible from a tax and cash flow perspective. And I would say this is a pretty good option to consider if you're going to need additional cash in retirement, but also kind of want to preserve your company culture. So that's kind of all I had on management buyouts. And next I'd like to talk about transfers to family members. So transfers to family members are obviously a great way if you're looking to set up your children, grandchildren, and if you've been really successful, even future generations past that. And this is going to be a great option if that's your goal, but know that it's going to take a substantial amount of planning to make sure everything goes smoothly. When you look at the statistics out there, only about 30% of the businesses survive to the second generation, and then only 12% are still around in the third generation. And really, I'd say a lack of planning is a huge contributing factor to these failures. So if this succession planning is right for you, I think it's going to be really important that you sit down and discuss this with your children and family. And I'd really want to make sure you explain to them what it means to be an owner of a company and not work in the business, and also what it means to be an owner of a company and work in the business. And then also, as you're setting this up, you're going to want to talk to your children and make sure this is actually what they want out of life. Perhaps they want to take over and run the business, but there's also a chance this is something they have no interest in, and you're going to need to plan accordingly. And we also see cases where some kids want to come in the business, but then other kids don't, and how do you balance things out and make everything fair? Managing these family dynamics is a really difficult area to navigate, and I'd say a lot of that is because there's so much emotion involved that it can really complicate matters. And it doesn't even have to be emotion related directly to the business. You see all the times where kind of emotions from old things get brought up in these matters, and it just really complicates the transaction. And then so that's focusing on the family side, but you're also going to want to focus on the business side. As you determine the proper way to transition to set up your family, I'd say it's also important to consider changes in how the actual company operates. So things like looking to add a board of directors if you don't already have them, that's separate from ownership. Or just making sure there's a solid organizational structure and the company's operating as soundly as it can. These things are going to ensure the company can continue to operate smoothly despite any constant changes in ownership. And then let's take a step back for a second and look at exactly how these transaction options for family transfers work. And really, there are going to be two kind of overarching ways you go about this. Excluding a sale, you're either going to do it via gifting or through setting up trusts. And so gifting might be the right option for you if you'd like your children to have direct ownership right away. And from a timing perspective, you can gift everything all at once, or you can set up a plan and make small gifts over time. It's really up to you and what's going to work best for your lifestyle. And then gifting is also a nice way if your business is worth roughly $10 million or less. And this is because between you and your spouse, you can each give in your lifetime almost $5.5 million in gifts tax-free. So this is a great, easy way to transition the whole company without any tax ramifications, if that's the case. And then if you're looking to set up trusts, I would say with trusts, it's very important to work with your advisors because there are so many different types of trusts out there that can be used to accomplish just vastly different objectives. So you're really going to know which one is right for you and your plan, and that's going to make all the difference when it comes to successfully transitioning your business. And then, quickly with trusts, from my experience, I would say a typical scenario is that before any trust gets set up and put in place, the company would get recapitalized into both non-voting and voting shares. So this would allow you to, transfer the bulk of the company to the next generation through non-voting shares, while you continue to control the company through, just a small amount of voting shares that you continue to hold. And then I would say it's pretty common for, you as an owner then to continue to hold these voting shares through your lifetime and them to the next generation through your estate, or gift them, later on in life. And, trusts are a really nice thing to utilize if you have enough time and the right amount of planning, because you can really work to transition the company like tax-free or minimize the amount of tax as much as possible. So, while transitioning your company to the next generation is a great way to set your family up and preserve your culture to ensure your legacy, you really have to sit back and think like you are in fact just giving it away if you're, gifting or using trust. There isn't going to be that big final sale at the end where you walk away with a huge chunk of cash. So I can't stress enough, it's really important for you as the owners to know what kind of lifestyle you want to live going into this, so that way you can properly plan to maintain enough ownership that's going to provide you with the income you need in retirement to do what you want. All right, and so now let's move on and talk about selling to third-party buyers. So there are really two types of third-party buyers out there: financial buyers and strategic buyers. Financial buyers are going to be somebody like a private equity firm who, comes in and does an analysis and bases price purely on rates of return and fair market value. While strategic buyers are going to be, other competitors in your industry or somebody looking to acquire you for synergistic reasons. Maybe you have a complementary product, or, it's a growth play on their part. They may be willing to pay a higher price for that. But both these buyers are good options if you're really looking to maximize the amount of cash you walk away with and for a quicker exit. One thing I'd caution you on, though, is if you're selling to a third party, especially, a strategic buyer, somebody else in your industry, there's a good chance that this can have an impact on your employees. If you sell to a competitor, all of a sudden this new merged entity has two CFOs, and there's probably not a real place for both of them.
So at that point, I think it's important to talk a little bit about the differences in strategic versus financial buyers. A financial buyer is really going to come in and pay you based on your cash flows, and it's very likely to be significantly less than maybe a strategic buyer. A financial buyer will look at your future cash flows and then determine what they'd be willing to pay for those cash flows as they go forward. A strategic buyer will bring in some other elements in, some synergies, cost savings, maybe taking a competitor out of the market and factor those things into their purchase price. So in general terms, a strategic buyer is very likely to be likely to get a higher price than a financial buyer.
Yep, that's a good point. Thanks, Brian. And really, in selling to a third-party buyer, it's kind of much like how you get your house ready to sell. Beforehand, you're going to look and try and fix some things up to bring it to market in the best possible shape. And I'd say really there are kind of four main things we recommend that clients do to prepare for one of these sales. And I'd say typically, you'd want to start preparing at least 3 to 5 years ahead of any potential sale, if at all possible. And so I guess now I'll get into these four main things. And the first one is to really make sure you have business systems in place. So before you want to make sure, before you sell, you really want to make sure your business is operating as best as possible, and you have all your systems in place that are, really important. It's a really important concept. Even something as small as, like your accounting systems. I've seen deals get tripped up because, the company doesn't have solid accounting systems in place, and, a buyer comes along during due diligence and requests some information. If you don't have the systems in place to provide that, I've seen deals fall apart because of something like that. And secondly, I think you're really going to want to clean up your financial statement. So this includes things like writing off bad accounts receivable or obsolete inventory. You're going to want to make sure your revenue is being recorded properly and getting rid of any non-business related expenses. These are all things a buyer is going to come and look for during due diligence, so it's best to clean it up beforehand. And then another thing if you're a pretty small company and you really only have kind of, let's say, fair to poor financials, a buyer is going to come in and expect to see GAAP basis financial statements. So it may be worth your time, if you know you're going to sell, a couple years ahead of time to start getting reviews or audits done, just to make sure your financials are in the correct format that the buyer is going to want to see. And then thirdly, you're also going to want to really focus on growth. This is another thing that buyers like to see. And it's also, the best time to sell a company and get the highest price if you want to walk away is when you've experienced some solid growth and things are going well. The flip side of that is, it's unfortunately probably the hardest time to sell because, as you're the owner, times are probably good. You're making lots of money and having fun doing it. But, if you're kind of struggling with that hurdle, I'd say it's important to look at it from the buyer's perspective. A company that's growing and things are going well and, everybody's kind of energized about it, this is going to be a lot more attractive for a buyer than, some old dog company where you're just tired and burnt out from grinding away and you're looking at a sale, as just a way to get out of your job and move on to the next phase. And then finally, the fourth option is to really kind of institutionalize your relationships. So typically, buyers want to keep those relationships with customers and vendors going when they buy your company. And your company is going to be worth a lot more if those relationships stay with the company and don't leave when you walk out the door. This is especially important if you're selling to a financial buyer. And, I can almost guarantee it that if you sell and you're still the key person with all the relationships, that buyer is, going to make sure you stick around long enough to make sure everything can transition smoothly and they can take over without a huge loss in those relationships. So I would say making an effort with those four areas are really going to go a long way to help you out in any third-party sales scenario and help get you the best offer. Also, in my experience, there are kind of three main challenges we see when selling to third parties. And the first one is really kind of terminology-based. So many times in selling to third parties, you're working with investment bankers. And when investment bankers are talking about company value, what they're referring to is typically what they call enterprise value. And so I think it's important to note that enterprise value is defined as the value of your equity plus all of your debts. And I've seen many times where business owners get fixated on this number and then are disappointed to learn, later on down the process that the money they're actually going to walk away with is significantly less because a lot of that cash is going to go to pay back any of the debts of the company that the new buyer isn't going to want to have. The second big challenge I find is that for a lot of business owners, their business is their baby. It's what they've spent their whole life doing, and there's a really strong emotional attachment to it that can lead to them believing the company is worth a lot more than it actually is. And this can be one of the hardest hurdles to overcome. And I really think it's a good idea to work with, valuation professionals, your accountants, to help gain an understanding of the actual valuation of the company, as well as what you're going to get, like what we kind of walk away cash, on an after-tax basis, beforehand, before you get into any sales transaction. This way, you're not going to be surprised or offended by any of the offers coming in. And then lastly, the final main challenge we see is actually going through the due diligence process. I'd say it's a very time-consuming process, and the owners who I've worked with before have kind of described it as having a second full-time job on top of running their company. So it's it can be a very stressful and intrusive process, but it's kind of best to think about it from the buyer's perspective. What they're really trying to do is just understand what they're buying, kind of how the business works, whether the financial information you provide to them is correct, and then also just be on the lookout for any surprises that could lead to adjustments in the purchase price. And then one other kind of thing I should note on due diligence, if you're selling to a competitor or some other strategic buyer, there's a lot more risk involved in letting them perform due diligence than there would be with a financial buyer. And it's because you're completely opening up your books, your pricing structures, your customer lists, all your operations and everything else to them. So you really want to make sure that before you get into a due diligence process, they're legitimately interested in purchasing your company and they're not just on the hunt for competitive advantage. And then lastly, on sales to kind of third-party buyers, and I know this is going to sound a little self-serving, but it's to really hire qualified professionals. CPAs, investment bankers, M&A attorneys, you look at some of their fees, especially for bankers, or maybe $500 an hour for an attorney, and it seems like a lot at first, but it's well worth it to make sure everything gets done correctly and smoothly. For many of you, you're only going to have one opportunity to sell a company. So, constantly I hear spending money on good advisors was always well worth it. And it's, something you should really consider. All right, so now I'll pass it over to Brian and let him talk through the final option, which is employee stock ownership plan.
Thank you, Emmett. So Emmett, like you mentioned, we're going to talk about ESOPs, or employee stock ownership plans. So for the right company, an ESOP can be a really positive and good alternative. In effect, what happens is the company is owned by the employees via a trust. So just a little bit about how they operate. An ESOP is a qualified retirement plan that operates very similarly to a 401k plan. The significant difference is that the main investment held within the ESOP is the stock of the company, of the operating company. In effect, you as the shareholder of the company sell your interest to a retirement plan that will own and hold the stock of your company. And then over time, employees are allocated an interest in the company in accordance with ESOP plan documents. There are many ways of structuring a transaction with an ESOP and many ways of structuring the plan. I don't want to get into the details on those sorts of things, but just keep in mind that there's lots of different ways of structuring things. So who might be a good candidate for an ESOP? There are some characteristics that we look for as we get people asking us about ESOPs. There are some things that we look for to make sure that they might be a good candidate. First and foremost, you must be a corporation, either a C corporation or an S corporation. Next is size, whether it be size in terms of revenues, in terms of employees, or in terms of payroll. There has to be a significant size company to become an ESOP. Otherwise, there's some anti-abuse rules that go along with ESOPs that you have to worry about. So you have to be probably in the neighborhood of, we tell people 75 employees, somewhere in that neighborhood or more is going to be a good candidate. Also, solid management in place is important. Profitability is important, and then also creditworthiness some ability to take on some debt on the balance sheet is important as well. So now I'm going to talk more specifically about some of the advantages and the disadvantages of becoming an ESOP. First and foremost, probably the largest advantage is it's very tax efficient. If you structure it the right way, the company does not pay any federal and probably not any state income taxes. The only way you pay state income tax as an S-Corp ESOP is if you filed in a state or you operated in a state where they don't recognize S-Corp status. Assuming that you don't, then there's no income tax paid by the company. This in and of itself is a huge benefit that can improve the cash flows of the company that can be utilized for other purposes. So whether those increased cash flows are used for other investment in another business or in machinery or some other way to expand or paying down debt, the cash flows generated by simply not paying tax can be huge. There are also some tax advantages to the selling shareholder. Structured the right way, the selling shareholder can defer income tax on the sale for as long as they choose to. There are some pretty specific rules on that, but you can defer income tax on a sale if you do it the right way. Last thing on taxes, from a tax perspective, the type of transaction, whether it be an asset sale or a stock sale, really doesn't matter to the trust. So typically, the form of that transaction is dictated by the seller. So as a seller, you're likely going to want to sell your stock and not your assets. And so if you do an ESOP transaction, the ESOP in general terms anyway, it's not going to matter to them from a tax perspective. The next thing I want to hit on is a partial sale of the company. Emmett had mentioned earlier that in our company and in our business, our client base, we see many business owners that have either all or a significant portion of their net worth tied up in their business. An ESOP could be a way to take some chips off the table and to diversify your holdings, either individual holdings or your family's holdings. You could sell a portion of it to an ESOP. You don't have to do it all. Third thing I'd like to talk about here a little bit is you're likely to be able to retain control and continue employment if you choose to. If you're not quite ready to retire and you want to continue in some capacity, this is a way to get the succession of your business started, and you're usually able to retain control of your company and if you choose to. The last thing is ownership culture. This is admittedly a little bit subjective, but there are many studies that have been done over time that have concluded that employee-owned companies tend to have more engaged employees and are more profitable in the long run. Obviously, that is subjective and not the case in every situation. But in our experience, to get that advantage, it takes more than just simply putting an ESOP in. It takes time and a significant amount of employee education and involvement to achieve those results. Now let's hit on a couple of the disadvantages that I see from an ESOP perspective. Probably the largest one is there's very likely to be some seller financing involved. The typical ESOP transaction contains some degree of seller financing, especially if the selling shareholder is giving up a significant portion of the company. Just give you a quick example of typically how an ESOP transaction would work. Let's just assume that you own 100% of your company and you want to become 100% ESOP. What would happen usually is the company would redeem all of your shares on a note. Then you would turn around either simultaneously or afterwards, go to a bank and ask them to lend you some money depending on your creditworthiness. However much the bank would give you, you would utilize that cash to be able to pay down the seller note, and then likely a subordination agreement is entered into on your note. So your seller financing note, your seller finance note would be subordinate to the bank debt. Obviously that has risks involved in it and maybe something that you're not willing to do. So you need to make sure that you're going into that with your eyes open. There are some creative ways to make seller financing more attractive, but if something catastrophic does happen, the last person to get paid is going to be you on your seller note. So clearly that's a risk that you're going to want to weigh for yourself. Another maybe disadvantage is continued employment. If you're the selling shareholder and you simply want to step away and retire, then an ESOP might not be good for you. Post ESOP transaction, someone will need to be there to run the company from a strategic perspective and also day to day. And unlike a third-party buyer, no one from the outside is going to be coming in to do that. If planned correctly, if you plan ahead, getting solid professional management in place, then an ESOP might be okay. But if you're just looking to step away and not have any involvement, then maybe an ESOP isn't perfect for you. Third thing is purchase price. By law, an ESOP can pay no more than fair value for what it is buying. So this very likely will be less than a strategic buyer would be willing to pay, and perhaps even more than a financial buyer, depending on the industry and other financial considerations. So if your main goal is to maximize your price, then an ESOP probably is not the best option for you. You should be looking probably at a third-party sale or some other type of transaction. Last thing I wanted to hit on related to negatives or some disadvantages is cost. I think there's a common misnomer out there that an ESOP transaction is very friendly and cheap, and I don't find that to be the case. I think that from a transactional perspective, the cost of a transaction goes really sort of close to that as a third-party buyer. Maybe not quite as much. You probably wouldn't have an investment banker in place, but probably pretty close to a third-party buyer. And then also, so as the transaction goes, there's a buyer and a seller. They engage in negotiations on price and terms. The only difference between that and a third-party buyer is that the trust is negotiations that are done with the trustee and his or her team of advisors. The trustee will have legal counsel, an evaluation firm helping with the transaction, and you, as the selling shareholder, should have an advisory team as well. Very similar to any other that's very similar to any other transactions. While an ESOP transaction is relatively friendly, there will certainly be negotiations taking place. So as I mentioned earlier, an ESOP can own 1% or 100% or anywhere in between of the company. There are no rules on how much you have to sell or need to retain, anything like that. On an annual basis, the trustee engages an independent valuation firm to value the stock of the company. This value is then the basis for how much individual employees are allocated. Then as people exit the company, their ESOP accounts will be cashed out, and the cash goes to them. The shares stay within the ESOP. So as people get cashed out, there is a requirement for the company to make contributions into the plan to be able to allow those people to cash their ESOP balances out. Okay, so that's what I had there on ESOPs. Now I want to hit the next slide. So we talked about 4 alternatives today for exiting the business, and we want to give you kind of an overview and some final thoughts on things. So probably the main thing that we want to get across is starting the planning early. You know, regardless of which route you take, whether it's management buyout, a third party, a family transfer, or an ESOP, planning is the key. And planning should be delineated in terms of years and not days or months. This is going to maximize your value and avoid unforeseen issues arising at the 11th hour. Identify your personal goals and objectives. Emmett hit on this earlier, but I want to hit on it again here. You know, do you want to retire completely? Do you want to maybe stay in and serve as a director? Do you want to continue on the day-to-day? Is company legacy important to you? What's important to your family? All those types of things are going to be important to get figured out prior to engaging anybody to look in and come in and do a transaction. And then lastly, Emmett mentioned this was self-serving, clearly is, but in our experience, it is important. Don't be penny wise, pound foolish. You know, engaging the right team of professional advisors is important. You know, in most situations, as we see it, a good team of advisors will pay for themselves in terms of dollars and/or reduce stress when going through the transaction process. Last thing, once you get it done, and to get all the papers signed, enjoy your retirement. Emmett, any thoughts that you have along those lines?
No, I mean, I think you covered it. I'd just like to really reiterate that, you know, you really want to start planning for retirement. You know, our hope here is just to give you a couple of thoughts and things to think about as you start to set up and some options to go down. But really take the time to think about what you want, and then don't be afraid to ask for help in going through all this. It's a very, very complicated subject matter.
All
So
right.
then I got Suzanne. Are we ready for questions? Can we open up the floor now?
Thank you both. Great information. Lots of things to think about there. We do have a couple questions from the audience. I'll just read them off and you guys can choose who would like to answer them. So first of all, we have a question. Is there a quick formula that can be used to estimate or calculate a company's value?
I'll take this one. You know, on a really kind of basic level, you know, the value of your company is going to be worth, you know, some sort of revenue stream divided by the risk related to that, which is, you know, a really oversimplistic way of stating it. But, you know, typically in kind of sale or transaction scenarios, how we see that play out is typically multiples of EBITDA. And, you know, you hear kind of a lot like, you know, your company is probably worth 5 times EBITDA. That's kind of where most people start. But really, you know, you're going to want to go a lot more into it. And, you know, what that EBITDA multiple is going to relate to the risks associated with your company and the industry you're in. And depending on what that is, it can vary drastically. You know, 1 to 2 times EBITDA perhaps. And, you know, I've worked with companies who have gotten, I think it was 15 times EBITDA. So, you know, there's no like perfect formula, but, you know,
you can probably do some internet searches on industries and what a multiple of EBITDA might be, but it really is dependent on specific circumstances and kind of what balance sheet looks like and things of that nature as well.
Yep.
Very good. Great. Thank you, guys. From an estate planning perspective, which of these options is best to consider?
Probably the most efficient one would be a family transfer, done over time with some tax planning alternatives. You can make it very tax efficient. I would say that's probably the first one, and then secondly, again, structured the correct way at ESOP probably would be second. Anything more there, Emmett?
No, I mean, if your goal is really to kind of transfer the assets out of your estate, I think doing it through trust or gifting is going to be the best way to do it and reduce the amount of tax.
Okay, thank you. Next question is, can a partnership or LLC become an ESOP?
Well, I'll take that one, Emmett. Under current law, no. You have to be a corporation to be an ESOP. The organizations that are promoting ESOPs in Washington do have some proposed legislation to allow partnerships and LLCs to become an ESOP, but under current law, it has to be a corporation. Now, if you are a corporation, again, if you plan it correctly, you can convert to if you're an LLC or a partnership, you can convert to a corporation to become an ESOP. It's just going to take a little planning and understanding the ins and the outs of that transaction.
Excellent, thank you, Brian. And then last question I have thus far is just a little more discussion. If you could talk a little bit more about the length of the planning process and the timing of these options, and then specifically, what if a situation calls for an expedited sales process?
Yeah, I'd say, you know, obviously we say try and plan 3 to 5 years ahead of time. That's really going to help, you know, maximize your value and get the most for your company. You know, sometimes things come up or you're forced to into a transaction earlier. That can certainly be done, but without the proper planning, you may have to, you know, sacrifice on some things and compromise and not fully get what you want. But time frame wise, you know, it can be done, you know, as soon as possible. But ideally, we'd really stress, you know, try and get some planning done at least 3 to 5 years ahead of time.
Okay, good stuff. Thanks for the questions, audience. And I'm just going to double check right now. Doesn't look like we have any hands raised or any additional questions. So with that, I'd like to throw a question out to the audience. And you can reply via email or through the questions chat. ArcherPoint is also an ESOP, so we converted over, I think about a year and a half ago. And we'd love to share more about this option if we have interest in the audience. So if you do have an interest in learning more about the ESOP option, we'd be happy to plan another webinar to dig down into some of the details there, because as it was mentioned by Brian, it's a very complex thing. But it can also be very beneficial.
Excuse me, sorry. Yeah, we just kind of scratched the surface on it today. There's a lot of things that go into it, but yes, if there's interest out there, that'd be great to do another one.
Yeah, we'd happily dive down deeper into that in a webinar all its own on the ESOP option, or others, or any other topics for that matter. So we do welcome everybody for their time today. We appreciate you setting aside a few minutes of your day to spend with us. We'd love to get your feedback on the questions we just asked and others. You can email your questions or feedback to info@archerpoint.com, and I can share that with the team. And we did have a couple questions come in here, so I'm going to go ahead and read those off. First question is, do all employees need to be in the ESOP?
Yes, I shouldn't say yes. The rules vary by plan, and if you think of most companies have a 401k plan. If you think of the eligibility for a 401k plan, typically what companies do is mirror eligibility, mirror the ESOP eligibility to their 401k plan. So have to be 21 years old, have 1,000 hours, those types of things. So there are rules on how exclusive it can be, but in general terms, yes, most of your full-time employees are going to be participants in ESOPs.
Great. And then I guess a follow-up to that was that can ownership vary by employee?
Yes, the way that the shares of the company within an ESOP are allocated is dependent on your compensation. So if you, just in a very simple example, if you have 2% of the compensation of your company, you're going to own 2% of the company. So it's based upon your compensation. That determines how much of an allocation you get of the company shares.
Great. Thanks for the questions, Jay. And thank you for the responses, Brian.
Mm-hmm.
So I think that covers our Q&A. Again, thanks everybody so much. We do appreciate your interest in this topic. It's like I said, near and dear to our hearts, and we want to make sure that everybody's planning ahead so they're not caught with any surprises and can truly enjoy their retirements. Again, info@archerpoint.com is the email address for your feedback. I thank everyone for their time and the speakers for their dedication to getting this information out to our audience today. With that, I'm going to conclude today's session. Have a great afternoon, everyone.
Thank you, Suzanne.
Thank you both.